Welcome to Inside Exchange, Topics for Manufacturers, a series bringing you expert-led presentations on the issues that matter most to members. The curated topics in this series feature presentations from associate members and subject matter experts through on-demand and live webinars to help Hudson Valley manufacturers. If you have topics you'd like us to explore in future episodes, contact us at info@councilofindustry.org. Let's begin.
Steve Howell from RBT, thank you for gathering with us today and pulling your team together to talk about this topic. I know it's timely and a lot of our members are asking. I'm going to just turn it over to you, and why don't you introduce yourself and the team?
Yeah, thanks, Johnny. And we're very excited to be able to present the One Big Beautiful Bill Act, sometimes known as the OBBB. And thanks to you and Harold for asking us to do this. Our hope is to give the audience a good general overview of the One Big Beautiful Bill. So with me to present is two partners in the firm of RBT. We've got Davide, who we're going to call Dav during the presentation, DiGenova, and Nick Watkins. Again, they're both partners in our tax department. Dav actually heads up our tax department, and Nick does a lot of work in the corporate world and also in the estate and trust arena as well, which this bill has an impact in that area also. So at this point, I'm going to turn the slideshow over to Dav, and he's going to direct us through.
Great. Thanks, Steve. As Steve mentioned earlier, the One Big Beautiful Bill is really a new legislation that has come out dated July 4th, 2025. It's an extension of some of the provisions back dated from 2017, the Tax Cuts and Jobs Act, or some people may know it, the TCJA. It answers a lot of questions that everybody's been asking about what's going to happen when the TCJA expires. Will tax rates go up? Will tax rates go down? There's a whole lot of new information. There's a lot of extension provisions that came in. As Steve mentioned earlier, the biggest thing to really focus in on is we're trying to give an overview of what's happened with the legislation. The IRS still has to come out with a lot of regulations underpinning all of these new provisions that have come out with the OBB. And there's just a lot of things that we still need guidance on from the IRS. It's really taking an overview of some key aspects for the industry and really focusing in on those hot topics that people are really interested in here. With that said, I know one of the first topics a lot of people are interested in is bonus depreciation and how that's going to affect businesses moving forward in the manufacturing industry. So, Nick, what do you see from the OBB and how's it going to affect businesses in this industry?
Yeah, well, some really good changes I think that came across from this. And we talk about the One Big Beautiful Bill. It's definitely a big bill. It's nearly 900 pages. Whether it's beautiful or not is yet to be seen, but we're trying to work through that, and hopefully it's really going to help the manufacturers in our area. But bonus depreciation was a big fix. So under the original TCJA, which was signed in 2017 under President Trump's first administration, allowed for 100% bonus depreciation, which really means if you were going to depreciate an asset over 5 years, this provision in the Internal Revenue Code allows you to deduct all of it up front. But the percentage that you could deduct right away was phasing down over a number of years. And before the Big Beautiful Bill, we were looking at a 40% bonus depreciation amount for 2025. What changed in this Big Beautiful Bill is that now the legislation allows for 100% bonus depreciation, and it's for property that's acquired after January 19th, 2025. And you might wonder why after that date, what's going on with that provision. But January 20th was the inauguration. You'll see some other provisions in this bill that play around that date. But really good thing that we're going to be able to see 100% bonus depreciation, the ability to deduct a lot of equipment and other assets that you're purchasing for your business. That's going to help to minimize taxes early on once you purchase those items.
Things too that I wanted to mention earlier is as we go through our discussion, and Nick was talking about bonus depreciation, there's some things too that we want to keep an eye on. How does this legislation from a federal standpoint affect the industry? But also you want to look at, state implications, which I think is important too, right, Nick, as we go through a lot of these provisions. Some states may not adopt certain rules that the IRS has put into place and things like that. So what are your thoughts there too?
Yeah, absolutely. And that's going to be another item that we're going to be waiting for to see how the states respond to it. Most of the states follow some sort of conformity to federal rules and regulations. New York State happens to be what we call a rolling conformity. So generally, when things change with the IRS, this New York State is going to follow those changes, except when they don't want to. So New York State does have the ability to decouple. Bonus depreciation is one area that for as long as bonus depreciation has been around, New York State has not followed that treatment. So you would still have to depreciate any equipment you might purchase over the useful life of that asset. So it's definitely a big consideration when determining whether bonus depreciation makes sense for your business.
And Nick, what does that legislation change in reference to the 40%? Does that mean that they can elect to take 40% this year in 2025 as an alternative to 100%?
Yeah, great question, Steve. Yep. So there is still that ability to deduct 40% for your bonus depreciation, as was the case under the previous TCJA, but now have the option to do it for 100% or 40%. So maybe it makes sense to not take that full expensing in the first year. There might be other considerations, tax considerations, to take a lesser bonus depreciation, and that's just for this first taxable year, 2025.
And just thinking out loud, Nick, in the case of manufacturers, sometimes bonus depreciation can be helpful because there are state credits, manufacturing credits that can be taken on equipment, where if you took bonus depreciation and it was allowed at the state level, you would effectively lose those credits. So in some cases, you kind of get the best of both worlds. You get accelerated on the federal level, but you get to keep your credits at the state level. Is that correct?
Yeah, absolutely. And it's really something that you want to model out when you're determining whether you want to take those types of state tax credits. So specifically, New York State allows an investment tax credit. So a manufacturer's investment in equipment or other production materials that go into manufacturing whatever they're producing, those assets are eligible for a 4% New York State tax credit in the first year. And then potentially in years 2 and 3, after the acquisition of that equipment, potentially if you increase employment by certain percentages, you could also be eligible for another 2.5% credit each of the next 2 years. So potentially looking at up to a 9% state tax credit over a 3-year period. And the rules are a little bit different for corporate versus non-corporate taxpayers in that sense. But if you're looking at combining that with depreciation deductions, really a great benefit for our manufacturers.
I've had a lot of clients that, let's use an easy example, have gone out and bought a $100,000 piece of equipment and had, let's say, a $500,000 personal taxable income. And assuming that the entity was an S corporation and was flowing that $500,000 profit to the individual might be hitting the 37% tax bracket, plus another 6.85% on the state, so almost 7%. So in a max tax bracket, that taxpayer could be paying 44% on the upper part of their earnings. So being able to take bonus on $100,000 and reducing that down effectively knows we're going to save $37,000 at the federal level. But then creating a $4,000 credit in the first year helps to offset the almost $7,000 tax that they would incur. And a little bit later on in the slide deck, I believe Nick will be talking about PTET, which is a methodology that can be used at the state level to help deduct those state taxes even further. But in that scenario, saving $37,000 plus saving another $4,000 on a $100,000 acquisition gives you a $41,000 savings right off the bat. So, that's a real life kind of situation that our manufacturers run into all the time. And it's nice to have that option.
So another provision that's in the bill also around depreciation has to do with what's called Section 179 expensing. So very similar to bonus depreciation, it's about accelerating depreciation, and Section 179 gives you the ability to potentially deduct the full cost of equipment that's placed in service. So what really changed in this area was just an increase of the limit for small businesses that they can expense. So looking at up to $2.5 million from what was previously about 1,250,000 prior to the big beautiful bill. And then as you place in service more assets over $4 million, that ends up getting phased out. But another option for taxpayers when thinking about depreciation, how to reduce taxable income, this is another great option. You're still looking at whether the states follow these rules or not. The states generally tend to follow Section 179 expensing more so than bonus depreciation, but there are different rules. And in terms of those state investment tax credits, Section 179, if you take that on the equipment, does not give you the ability to utilize those credits. So you're losing out on those while still getting the same depreciation benefit that you would get under bonus depreciation. So it's always a good thing to just weigh the pros and cons of each of those.
Yeah, and I would emphasize as well, when you're looking at whether you're going to expense under bonus depreciation or Section 179, a lot of our businesses these days are multi-states. So you really want to take a look at those provisions to make sure that the states will allow or don't decouple or don't limit the expensing on the 179 or the bonus depreciation. Sometimes you may get, if you're not planning correctly, you may get surprised when you file those state tax returns.
Yeah, and just looking in our area too, between New York, New Jersey, Connecticut, some of these, the tri-state area, New York's the one that does follow Section 179, but as far as New York State for bonus and New Jersey and Connecticut for bonus or 179, they don't follow the federal treatment. So there are different rules on that. You do get the benefit eventually, but it's over time. So yeah, to your point, Dav, is you don't want to expect that you're going to be getting that deduction on the state level if you're really not.
So next up, we have something that I've heard a lot about. I've heard a lot of people inquiring about, but it is the 100% depreciation election on real property. You basically, property used in the production of tangible personal property or manufacturing. So, Nick, can you kind of give us a little bit more detail around that? Explain what that is and how it's going to be beneficial to the manufacturing group.
Yeah, absolutely. And a lot of the provisions in this bill really looking at spurring investment back in the United States. And one of the things they're trying to do is with this 100% depreciation for what's called a qualified production property. And it's giving taxpayers the ability to fully expense in the year of generally construction or acquisition of a personal property. It's got to be non-residential, so you're looking at commercial property that's used in manufacturing or production of property. And the construction's got to take place between January 20th of 2025 up through the end of 2029. And the property's got to be placed in service before January 1st of 2031. So what this is doing for our manufacturers is really giving them an ability to fully expense the portion of their building or their property that's specifically used for manufacturing and production. So you're not looking at spaces such as office space or lobbies or restrooms. Any of those areas are not going to qualify. So it's really going to be, I think we'll see a lot of cost segregation studies around this area to really bifurcate what part of the building is for that manufacturing production piece versus everything else. But it could be a pretty substantial savings rather than depreciating the life of that property over 39 years, which is a very long time. So being able to accelerate that is going to be a huge tax savings early on for a lot of manufacturers.
On the previous slide, you see QPP and QPA. What do those really mean, like qualified production activity for a QPA, qualified production property?
Yep. So the qualified production activity is you're looking at things around manufacturing and production of tangible personal property. The qualified product's got to be tangible in nature. And so looking at our manufacturers, any type of widget that they're producing in those facilities, it's going to qualify as that qualified production property.
And then a lot of what's been said is it's got to be new property. How does that work with the taxpayer? If they purchase a building, if they're building a building, how does that all work out?
Yeah, so it's generally got to be original use to that taxpayer. So the taxpayer can't have previously used it and then try to claim a 100% deduction on the property. And it can't be a qualified production activity for another person. So if you're just buying a manufacturing facility that's already in place, but somebody else is already using it as a manufacturing facility, that's something that's not going to qualify. And we're also looking at the property having to be owned by the manufacturer itself, the one that's claiming the 100% depreciation on that. So in a lot of instances, we see where the property might be owned in a separate entity. In this situation, the property really needs to be owned by the manufacturer itself in order to qualify for that 100% deduction.
I know a lot of businesses may own the business in one entity and own the real estate in another entity. That's where the planning really comes into play, especially if you're planning to build a facility to do the manufacturing. If you want to take this 100% bonus depreciation, you can. And then the other thing really is it's on the square footage that you're actually doing your production on, as Nick said before. Those are critical points in this whole potential 100% depreciation of this property, and what has to really be looked at in your planning when you're going through whether this is going to be beneficial or not for your business.
And there are some things you have to be careful too. There is a 10-year period, what we call a recapture period. And really what that means is if you change the use of that manufacturing facility within 10 years of the placed in service date, is that the full amount of the bonus depreciation you claimed originally is now going to have to be recaptured. And essentially that means you're going to have to pay ordinary income tax on that. So if you're subject to the highest tax rates and change the use of that, you might be looking at a big tax bill on the back end of that. And again, the idea behind this is to spur economic development in the US. And if you're going to allow the 100% bonus depreciation for that manufacturing and production, we want you to keep it like that. We don't want you to take the deduction and then change it to a whole completely different use of that.
And Nick, I think many of our viewers obviously won't understand what Code Section 1245 means, but typically real estate would fall under Code Section 1250, which means when it's sold, it's recaptured in a different manner. But 1245 is actually a personal property code that the government is basically saying if you do dispose of this property within a 10-year period, you're gonna have ordinary recapture, as you pointed out before.
That's right. And generally, in a lot of instances, when you sell real property, you're generally paying some level of capital gains tax, not necessarily ordinary income tax, and there might be some higher capital gains tax that are factored in there. But yeah, so this is really an incentive to make sure that if you're going to take that 100% bonus depreciation on your qualified production property, is to make sure that it's going to stay and maintain that purpose. Otherwise, like I said, on the back end, may seem like a good idea up front, but if you have ideas for 5, 10 years down the road, you might end up with a large tax bill that you weren't expecting.
Yeah, you also may have to realize too that you could end up with a 15-year mortgage on the real estate, but taking the depreciation deduction in 1 year means that you're really running for 14 years with a cash flow payout against the mortgage and no depreciation expense. So this is one of those things you really have to talk to your tax advisor about. Sounds really great up front and certainly could be very beneficial in certain situations, but it also may be harmful in the long run. So you definitely want to discuss this with your tax advisor.
And with this provision too, I don't necessarily see it being as much of an incentive. I think it's more if you had plans of building a facility, I think it's the timing of it might be perfect. It might work out great, but I don't know that I would specifically say, hey, let's go build a new facility now just because of this. So again, trying to weigh out all the facts and circumstances and what you got going on with your business and what you're trying to accomplish at the end of the day too.
Be beneficial for the business and for the individual, especially if you're doing pass-through taxation as an S corp or a partnership. You always have to look at what's called as excess business loss. Those limitations on the personal return can potentially offset or negate any beneficial deductions that you would get on the business side if they exceed a $500,000 limit on the personal end. So you really got to be careful on large deductions like this to make sure that they're really going to be beneficial as a flow-through taxation point. All right. Any other comments on the qualified production property deduction or anything like that? Steve, Nick, you guys good?
No, I think we still have a lot to learn. Again, New York State will probably decouple from this because it seems like it's like bonus depreciation. However, New York State generally responds very slowly to these federal changes. So, it most likely won't be till the end of the year that we really find out how New York State responds to some of this. But this is probably an area that New York State is going to decouple. At least that would be our assumptions at this point.
Yeah, I would agree. I think New York State generally decouples from the bonus depreciation regime. We'll have to see. Another thing too is that what I've been seeing in a lot of the legislation that's coming out from the OBBB is that the time frames for when those provisions go into effect, there's some that go into effect for 25, and there's some that go into effect for 26. So it's important when you're going through this with your tax advisor that you're able to make sure that whatever you're planning to do is for the appropriate period. There's a lot of provisions that are going to expire as of 12/31/25, and then the new OBBB takes effect. And there's some provisions that will go back to 2025, January 1, 25, and take effect going in that period. So it's just important really to look at that as well. Another topic that has been really big in the original Tax Cuts and Jobs Act was the qualified business deduction. As many people who are listening to this, if you're a pass-through entity, you're probably benefiting from the 20% deduction. There hasn't been a whole lot of change to this. The OBBB has made the QBI deduction, or the qualified business income deduction, permanent at a 20% rate. So that's been beneficial. There hasn't been any other changes really substantial with respect to the phase-in limitations. Most of the listeners here will be not considered SSTBs or specified service trade or businesses. So really, if you're in excess of the thresholds with regard to the qualified business income deduction, you're going to really be looking at having wages that will see whether your deduction of that 20% is going to be your deduction, or will your deduction be limited to the amount of wages that you are paying. One of the things that you may want to look at is if you're a sole proprietor. Generally, sole proprietors or single member LLCs that are owned by one individual, if you're conducting business. For 2025, if you're married filing joint and you're above approximately $390,000 in modified adjusted gross income, you start to phase into the limitation of wages in your qualified business income deduction. So that means, for example, throw out simple numbers. Let's just say you were making $100,000 for this current year, and your qualified business income deduction at 20% would be $20,000. What ends up happening is, if you're not paying any wages, you may start to phase into the limitation of the 50% of wages. So one of the planning opportunities here is, do you want to look at potentially triggering and making that single member LLC an S corporation, or potentially injecting another partner into that single member LLC to make it a partnership, so that you can pay wages to yourself or as an S corporation, or you can end up hiring, or you can hire people in the single member LLC as well But sometimes it's good just to think about, all right, if you're going to be increasing your net income and you're going to be exceeding taxable income in 2025 of approximately $390,000, will you start to phase out of that 20% deduction or not? Those are really the planning opportunities around the qualified business income. For the most part, there hasn't been a substantial change in the QBI TCJA. There is a small provision which allows, if you're making at least $1,000 of qualified income, you're going to get a $400 deduction moving forward. And that's going to be adjusted for inflation as well as the limitations, phase-in limitations moving forward. So, Nick, Steve, do you have any comments on that?
Yeah, no, I think the big change there is obviously extending the qubit deduction, which was going to end at the end of the year. So that 20% deduction, we see that as a really huge deduction for many of our manufacturers. And generally speaking, our manufacturers have the payroll capacity to take the deduction even if they exceed the limits. So this is really great news for manufacturers for sure. So let's move on to R&D. Maybe arguably one of the best benefits that the OBBB gave to our manufacturers is the change that they've made to the R&D amortization. So back in 2022, Section 174 came into play. It had been in existence, but it had been stalled prior and only came into effect in 2022. And just to remind our viewers, what happened in 2022 was any of your Section 174 costs, which are the costs basically that are incurred in order to create the R&D credit, had to be then amortized over a 5-year period. So this was a significant hit to manufacturers and was kind of contrary to, the whole discussion about bringing onshoring back here to the States and helping manufacturers out, because having Section 174 kick in was certainly not a help to our manufacturers from a taxing standpoint when they had to capitalize those costs and then amortize over 5 years. And we had clients with add backs in some cases of over $1 million. So these were pretty substantial. So the good news is the legislative change is that now those 174 costs can be expensed just as they had been prior to 2022. And so as long as they're domestic research and experimental expenses, they can now be expensed again. And effectively, you get your R&D credit calculated the same way as you did prior to 2022. That does not hold true for foreign research and experimental. That has to be capitalized and amortized now over 15 years. So this would only be for domestic research and development. So in addition, so many people obviously ask, well, what are we doing with the amortization that we have in place? We've got 3 years worth of amortization coming into 2025 from 2022, 2023, and 2024 that still remain on our tax books. What do we do with that? Well, the great news is that you have options. So if your gross volume is less than 31 million, you would be considered, in this case, a small business, and you can elect to actually retroactively go back and amend your returns for 2022, 2023, and 2024. So if you had big income in any of those years, obviously that could be a great relief and a great refund to you. And on top of the refund, the government will have to pay you interest when they refund you the money. So there can be a gain from the interest side as well. So you really have to look at where you were in the prior 3 years and what kind of taxable income you had and what kind of tax rates you were paying to determine whether that's a good option for you to go back and amend. Because the other option that you have is you can either take all of the amortization that's left in 2025, or you can split it and take half of it in 2025 and half of it in 2026. So if you're having a fantastic year this year in 2025, you may say, you know what, it's more beneficial for me to just take that amortization this year. Or if you project that 2026 is going to be a big year for you, you may elect to take 50% this year and 50% next year. So this really leads to some really terrific tax planning that that you can do. Just to highlight again, to carry back, you end up with, some nice refunds if you were in a high tax bracket in the last 3 years, plus a little bit of interest. The downside to that is you have to remember that there's a cost to amend those returns. In many cases, most of our manufacturers are S corps or partnerships, so that corporate level return has to be amended. And then, of course, all the S shareholders or partners in the partnership, all their personal returns have to be amended. So the win of having interest income come from the government may be offset by the loss of having to pay your accountant to amend those returns. You also open those 3 years up to a new 3-year statute. So, you may want to think about that. Do you really want to open yourself up to additional years that the IRS can audit you? And frankly, you may wait a couple years to get your refund, because our experience here has been that refunds are very slow to be processed and very slow to be paid out. We've had clients that have waited longer than 2 years to get a refund. So you have to really weigh out what the best benefit is. But this is an outstanding provision for our manufacturers, and certainly we're very excited. There is no downside to this provision that we can think of.
And boy, Steve, wasn't this just so controversial over the last 3 years? I mean, the talks in Congress that, both sides of the political party wanted to make those R&D costs to be able to expense them and just couldn't make it happen. So the fact that we're finally here, after a July 4th bill in 2025 and finally have this pushed through, it's really, really a great benefit and needed to happen. It should have happened a lot sooner, but great that it finally did.
Yeah, and sad, Nick, that it didn't happen 3 years ago, because we really did have a lot of clients that suffered through this add back, and spent a lot of tax dollars because of the add back. And you're right, this was a ball that was being bounced in the air for the last couple of years. So it's nice that at least this provision came through, and we know what we're dealing with now at this point.
And just one other item too, Steve, on the R&D is also consider, if you're going to amend those returns, consider the state tax consequences too. Like we talked about with everything else, some of the states conformed to the treatment and required you to capitalize the R&D, but some states still allowed for a full deduction of R&D. So you might have some other adjustments on your state returns that could get a little messy, but we'd still want to wait for guidance from the states to see how that is going to be treated.
Yeah, good point, Nick, for sure.
Moving forward as well, another hot topic was the business interest limitation. With the old law, the business interest limitation was generally under Code Section 163, and what that did was limit interest expense that a business was able to take depending on how that business was structured. So one other big ticket item was the business interest limitation. Back pre-22 in the TCJA, you were able to add back to your taxable income your depreciation, your amortization, your interest expense. After 2022, you were only allowed to add back to your taxable income your interest expense to determine what limitation was going to be for the interest expense. So really what's happening now with the new law change is they're going back to the pre-2022 rules, where it's your taxable, your adjusted taxable income, you're going to be taking your taxable income, you're going to be adding back your interest expense, your depreciation expense, your amortization, to determine what your adjusted taxable income is. And you're going to multiply that by 30% to see what your limitations are for your business interest limitation. Now, the biggest things here is that your Section 163J expense, or your business interest limitation expense, if you're a small business, you're accepted from this provision. Where it tends to really hit home is for pass-through entities, where there is a 35% or more allocation of losses to those partners or shareholders who are passive in nature in those businesses. This is where a number of the small business may get affected by this limitation. But now you're going to be able to add to your taxable income to determine that disallowed interest expense you're going to be able to add back your amortization, your interest expense, your depreciation. You're going to be able to go back to the pre-2022 rules, which will help determine what that limitation is. We're going to go into no tax on overtime.
This is one that for sure employees are going to be talking about and kind of exciting for them. Doesn't mean too much to the employer, to be honest. So employees will now be able to deduct $12,500 per year in qualified overtime, $25,000 if they happen to be joint filers. The deduction does, however, have phase outs involved. There's a phase out of $100 for every $1,000 of modified adjusted gross income that you're above $150,000 if you happen to be a single taxpayer, or $300,000 if you're a joint filer. So doing the math, that means that once a single filer has modified adjusted gross income of $275,000, or a joint filer has Maggie of $550,000, the deduction will be completely phased out. So the middle class is getting hit a little bit on this particular deduction, but folks under 150,000 are going to see a nice little benefit. So the important thing is to recognize that overtime is meant to be calculated in the same manner that it has been calculated in the past. I think that there's a lot of room for people to try to play games in this arena, and I think the government is going to be pretty strict on how they write their rules, because they want this to be strictly an overtime type of calculation. So obviously for salaried employees, this is not going to kick in, but for those hourly waged folks, you're going to treat overtime the same way that you've always been treating it. And if they're getting time and a half, then obviously it's the half part that we're talking about. We're not talking about the full wage, but just the overtime piece. The wages are still going to be subject to FICA and Medicare at the employee level and the employer level. So it's really just a savings at the federal income tax level and at the state income tax level. So the government is still going to have to figure out how to modify their withholding tables, because for folks that do qualify for this particular deduction, they don't technically have to have withholding on the overtime if it can be calculated. As we see it right now from a compliance standpoint, if you're using an outside payroll service, they should be able to track what that overtime amount is. If you're doing payroll internally, you're going to have to make sure that your system, can track the overtime dollars, because most likely on the W-2, there's going to have to be another box now included on the W-2, which will include the overtime amount, so that your tax preparers can figure out whether you're qualifying for that deduction or not. Non-itemizers should be able to take this. It looks like it's going to be a benefit that's added to the standard deduction, but we're not quite sure how it's going to flow through the 1040 yet, although they seem to indicate that it'll be an adjustment to either your standard deduction or your itemized deductions. The effective date for this is January 1st. So if you had no methodology of being able to track this deduction, they basically using the prudent rule that when it comes to filing the W-2s at the end of the year, you're going to have to kind of calculate in your best manner what those overtime wages were.
So similar to the original TCJA, they had increased the standard deduction. They're going to continue with that standard deduction, and they're going to be increasing it a little bit moving forward. Pretty much for 2025, the inflation adjusted basic standard deduction amount for a joint filer is going to be $30,000. Surviving spouse would be $22,500, and single filers would be $15,000. So that's where we're at in 2025. The legislation change moving forward. So the increase in the standard deduction, the basic standard deduction for tax years beginning after 2025 is going to increase to $31,500 for joint filers, $23,625 for head of household, and $15,750 for single filers. So there's going to be a small increase in the standard deduction. Obviously, it's going to be indexed for inflation, so on and so forth. Again, similar to some of these provisions, this section is in effect after December 31st, 2024. So these are the changes for the standard deduction. One of the things to think about here, and roll this into some of the state tax planning Nick had mentioned earlier with regard to potential New York State pass-through entity tax and what a small business can take, is you may want to start looking at your benefits for New York State pass-through entity tax, and then also your standard deduction. This next slide here is going to be your SALT limitation. There's some planning opportunities with regard to the SALT limitation, to your increased standard deduction, and potentially being able to take New York State pass-through entity tax, which is the business paying the New York State or state tax on your behalf. Nick, do you want to take over and talk about the SALT cap?
Yeah, sure. And as we're going through these things, I'm thinking like talk about all these hotly contested items that if you've been listening to or watching the news over the last couple months or really the last couple of years, there's so much talk about salt on the news, and it has nothing to do with your blood pressure or your heart rate. It has to do with state and local taxes. And looking at increasing the ability to, if you're itemizing your deductions on your personal income tax return, you were previously limited to a state and local tax deduction of $10,000. So that includes your income taxes, state income taxes, property taxes, sales taxes. That was limited to $10,000. And a lot of jockeying back and forth, and they finally came up with a number of $40,000. So starting in 2025, if you're itemizing your deductions as an individual taxpayer, you're now able to deduct up to $40,000 of those state and local taxes, except in case you start going over a certain income threshold, of course, right? So over $500,000 of modified adjusted gross income is when your SALT deduction begins to phase out. And between $500,000 and $600,000, once you reach that $600,000 threshold, you're now capped at that $10,000 state and local tax deduction again. So there's going to be, I think, a big jump in effective tax rates when you're around that middle class $500,000, $600,000 range, that if there's planning opportunities to keep yourself below that amount in order to maximize what that SALT deduction might be, those are things you got to start thinking about now. I think a lot of work that went back and forth trying to come up with this $40,000 number, and it's anybody who's over $600,000 is still playing by the old rules at this point. So interesting to see how that's going to play out. And then after in 2030, that's going to go back to $10,000, unless of course something changes between now and then, which is certainly possible. But again, that SALT deduction, the $40,000 limitation, is effective for tax year 2025. Steve, do you have any thoughts on the SALT cap?
Yeah, I was just going to say, it just means a lot more planning for, to your point, Nick, to those taxpayers that do get up into that $500,000 range between SALT and PTET, which you're going to talk about in a second. There is a lot of things that you may want to do to postpone income or accelerate income, depending on what the circumstance is around some of these limitations. Of course, with the standard deduction at 30,000 for a joint filer, in many cases, people struggle to get over that number anyway, right? So it really just depends on what your state taxes are and what your local real estate taxes happen to be, and that can be on multiple properties, right? So, every taxpayer is going to be impacted by this differently, and that's why it's important to really make sure that you do tax planning with your tax advisor before the end of the year so you can make some changes while you have time. At once the year is over, there's not a lot that tax, preparers can do, right? So you're going to want to make sure that you take advantage of planning opportunities.
Right. And the other thing that we're looking at, and we hear now, oh, the SALT cap has increased, to $40,000, but as Nick said, there's a cap there at $500,000, right? If you go exceed that $500,000, then you're kind of going back to the old rules. There's also, well, since the SALT cap has increased, I'm not going to need to, maybe do pass-through entity tax for New York State or any other states that we may be doing pass-through entity taxes for. But I think with the increase in salt cap and the standard deduction being so high that I think you have the ability now to even take more advantage of your New York State pass-through entities tax regime, and also, any other state tax, pass-through entity taxes that are out there, like for New Jersey and Connecticut and so on and so forth. So Nick, do you want to kind of explain a little bit about the pass-through entity tax and how that really kind of couples into this whole new bill as well?
Yep, and the pass-through entity tax is not something that's new. It's not something that's part of the big beautiful bill, but it was something that was discussed during negotiations about potentially changing the state's ability to have these types of pass-through entity tax deductions. And with New York State, what it allows is you have the ability, if you're a partnership or an S corporation, to make an election. That business entity will pay the taxes on behalf of the business, the state taxes on behalf of the business. And rather than having a potentially non-deductible state income tax that's paid by you personally, say if you just take the standard deduction, or say if you're limited on your state and local tax deduction, that you can deduct those state taxes at the business level. It's now a business deduction. So it doesn't have any interplay with the state and local tax deduction. What's interesting about this is if you're a high income earner, if you're steadily over that $600,000 of adjusted gross income, the pass-through entity taxes, if you're a business owner, I think are going to continue to be super beneficial, especially if you're not going to get any benefit of the increased salt cap. I think there's an interesting opportunity if you're in that mid-range, if you're probably between that, maybe that $300,000 to $700,000, maybe there's a little bit of fluctuation from year over year, is to see if there's things you can do to maximize the benefit of that pass-through entity tax deduction while also trying to recoup some of that, potentially up to $40,000 of the salt cap. There might be some ways to balance that out to maximize your deductions there. But it's really going to be interesting to see as we start planning these things out and looking at the different scenarios to see what's going to be most beneficial. For 2025, it's a little bit trickier in New York because you have to have made your pass-through entity tax election already. Those are currently due as of March 15th for the taxable year. So if you're already into that, you're into that. If you're out of it, you're out of it. But potentially in future years, there might be opportunities to play around with that. But in general, pass-through entity tax deductions have been very popular. Most states have some version of them. And I see them, even with this increased salt cap, I see them to continue being very beneficial to business owners.
Again, a lot of these no tax on tips, the no tax on overtime, the no tax on Social Security they're all really deductions that you'll be receiving on your personal income tax return. For the big beautiful bill, the senior deduction is for taxpayers age 65 and older and their spouses. If they're filing jointly, the senior deduction, similar to the other no tax on tips and no tax on overtime, are all deductions that will be provided on the individuals, the taxpayers 1040. So for the taxpayers, the age 65 or older, if they're jointly filed, they'll claim $6,000 per qualified individual. Extension on enhanced and reduced income tax brackets. Steve, take it away. This is,
As we pointed out in the very beginning of the program, I mean, one of the biggest benefits to the One Big Beautiful Bill is that it effectively extended all the tax rates, right? So if the bill had not been passed and nothing was passed, then at the end of 2025, everything would have reverted back to what I'll call the Obama tax rates. So there is an extension now of all these income tax rates, the brackets of 10%, 12%, 22, 24, 32, 35, and 37, which basically represent a 3% difference from where they were, not across all the boards, but 12% used to be 15%, 22 used to be 25, and so on. 37 used to be 39.6. So these new rates are locked in. So clearly, this is one of the biggest benefits to the bill.
So that kind of wraps it up for a number of the provisions on the big beautiful bill. I know there's a lot of other items in here, but we're just really trying to focus in on some items that really hit on the manufacturing industry, and then some other hot ticket items that people have been hearing about and had questions on. So any other comments, Nick, Steve?
There's a lot to this bill. There's a lot of items that we didn't go over, but certainly I think the advice that all of us would give to anybody listening to this is make sure that you consult with your accountant. Make sure that you do some proper tax planning this year. There's certainly things in this bill that in one way or another are going to impact you, and you're going to want to make sure that you've planned for these changes and you've taken advantage of anything that obviously legally that you can take advantage of.
Yeah,
So
that's great. Nick, any final thoughts from you?
Like I said at the beginning, this is a big bill. So we very, just highly touch the surface of it, but a lot of things to see. It's never too early to start planning. So definitely encourage you all to start planning now.
Yeah, I think it's an ongoing conversation. I think that this was good for that skim the surface. Let's cover a lot of things, but a shallow amount today because of the time constraints. But as things roll out and you get a little bit more clarity, we can always hop back on and go a little bit deeper into one topic or another. What I wrote down was clarity on the lack of clarity. So now we know, and we know what we know, but there's still a lot that's to be determined as everything else continues to roll out. We've been saying this for years, but the most important thing on our end is that our members have a bit of a proactive relationship with their providers, across the board, bankers, accountants, across the board. And this feels like the time that they should be having those conversations and reaching out and asking those questions. We get one-off questions here and there, how do you think this will impact my business? We're fielding them out and guiding as well. But I think it's a ongoing conversation, both with us as an association and with you and with our members, but also, and more importantly, for these manufacturers to be speaking to you or to their advisors and representatives as well. So I'm not going to ask any more questions. I appreciate you guys taking the time to do this today. It was fun. We'll go deeper at another time, but thank you. Thank you for taking the time. If anyone has questions, can I provide that information?
absolutely.
Okay, good. We'll make sure we make that connection. Thank you so much, and we'll do it again sometime.
Our pleasure.
Thank you for watching Inside Exchange, Topics for Manufacturers. We hope you found today's episode valuable. To learn more about the Council of Industry and explore additional resources, visit us at councilofindustry.org.